Hello everyone, today we're talking about differential analysis and product pricing. Well, when you're in a business, sometimes you have to make decisions where you have to decide between two different alternatives. So let's just say alternative A and alternative B. Looking at those alternatives, you have to examine the revenues and the costs for alternative A versus the revenues and the costs for alternative B. Some of the decisions we might be trying to make might be whether or not to buy or make a product, discontinue a product line, buy or lease equipment, etc. So with this, we're going to do each one of those scenarios, and I'm going to show you how you analyze these two different sets of costs. Now, before we go into actually looking at numbers here, one thing I want to mention is something called sunk costs. Sunk costs are very important when making a decision. When you're making a decision, or actually, they're really almost irrelevant when making a decision. Sunk costs are those costs of money you've already spent. All right, those are costs that have already been incurred. Those costs are not relevant to your decision making. If you're trying to decide between two different alternatives, alternative A and alternative B, you're not to consider costs that you have already spent or have incurred. You're only to consider costs going forward. So what costs, any costs that have already happened are not part of your decision, and they're referred to as sunk costs. So just to give you an example, when I was in cost accounting in college, one of the examples my professor had given us was that if you have already spent money on tickets to a sports game, and somebody has now asked you whether or not you want to go to the movies on the same night that you have the sports game, your decision should be based on just the fact that you would have to spend more money to go to the movies where you wouldn't have any additional money to spend going to the basketball game. You should be comparing those two costs. Maybe the basketball game or the sports game that you might have might be like that you'd have some cost of food or something like that. That would be alternative A. Alternative B would be going to the movies with your friend, in which you'd have to pay for movie tickets, etc., and food and popcorn, all those good things. What you would not consider is the fact that you have already spent the money on the basketball tickets in the past. The basketball ticket cost is a sunk cost. It has occurred in the past and shouldn't be considered for future decision making. As I said, you should only be considering costs that you still have to incur in order to make the decision between the two different alternatives. And I know this goes contrary to thinking how you pretty much live your life, but from a managerial accounting standpoint, that is how you're supposed to be making decisions. Okay. It's just the basic format for determining revenue from two different alternatives versus costs from two different alternatives. We're going to be using this in just a minute when we're going to use it for an example. Okay, here's the example we're looking at. Marcus Company is considering disposing of equipment that costs $200,000, has $120,000 of accumulated depreciation. Okay, now what that means to you is basically the book value of the equipment right now is $80,000. All right, the equipment can be sold through a broker for $100,000 less a 6% commission. Now back to that whole sunk cost concept. Do I really care what the value of the equipment is? The answer is going to be no, because that's the fact that the equipment cost $200,000 several years ago pretty much is irrelevant to me. That's all a sunk cost. What I am going to consider are going to be future costs. Okay, so one alternative is we can sell the equipment through a broker for $100,000 minus a 6% commission. The other alternative we have is a company called Potamkin Company has offered to lease the equipment for 5 years rather than us selling it for consideration of $160,000. So we have two alternatives here. Are we going to keep are we going to sell the equipment, or are we going to lease the equipment? A little bit further information, let's look at the costs now. The costs are, if at the end of the 5th year of the lease, the equipment is expected to have no residual value. During the period of the lease, Marcus Company expects to incur repair, insurance, and property taxes estimated at $35,000. Now what's going on here is if we sell it, we just sell it, and that's it. We don't worry about it. But if we're going to lease this piece of equipment, then what's going to happen is we are going to incur some additional costs. We're going to have to pay repair, insurance, property taxes, about $35,000. So that's an additional cost that we need to consider. Alright, so this is how we're going to look at it. We're going to look at differential revenue versus differential cost. We've got the revenue from the lease versus the revenue from the sale, and the cost of the lease versus the cost of the sale. So looking at this, your revenue from the lease how much money were you going to make on that lease? You were going to make $160,000. Oh, I should probably give myself commas here. All right, you're going to make $160,000 on the sale if I leased the item. Oops. And I was going to make $100,000 on the sale. So the differential revenue is the difference between the two. I'm going to make more money from the lease. However, let's look at the costs associated here. The problem with leasing the property is, remember that I still have to maintain it with repairs and maintenance expense and property taxes and such. So it's $35,000. Whereas if I sold it, the only cost I would have would be this cost of the commission. So the differential cost of the lease is the difference between the two of these. Now, the idea here is that if I went with a lease rather than a sale, notice that's the first number I start with. I start with lease minus the sale, lease minus the sale again. The idea is if this winds up being a positive number, which in this case it is, the revenue from the lease exceeds the costs of the lease, then leasing is the better way to go. I'm going to make more money by leasing this item than I would by selling it. And there we go, there's the accountant in me, making it $31,000. So if this were the case, the point is I would have differential income from the lease, and this would be the alternative I would choose. Like I said, if this would be negative, in the sense of that you wouldn't make as much money from the lease as you would from the sale, then I would sell the equipment instead. Alright, next what we're going to be looking at is we're going to be looking at discontinuing a segment of operations. So here we've got a company that makes cornflakes, toasted flakes, and bran flakes. And if you look at this, you can see cornflakes is turning a profit, toasted oats is turning a profit, and bran flakes is not. So looking at this just from a standard point of view, this is your normal balance sheet: sales minus cost of goods sold, both variable and fixed. Gives you gross profit minus any operating expenses, both variable and fixed. If you just look at this from the normal standpoint, you would see that bran flakes, it might be a line you might want to discontinue. However, as we know, looking at fixed costs is not always the best way to analyze whether or not a product is profitable. Because what if you have some fixed costs that you can't do anything about? And it's not bran flakes' fault that maybe that you're using a really expensive factory to make the bran flakes in, or has a really high property taxes on it. That's not bran flakes' fault. If you'd put cornflakes in that very same property, then cornflakes might be at a loss. So the trick here is to be analyzing based on variable costs alone, which is something you're familiar with from a much earlier chapter. So looking at this, as it says, bran flakes is what you would discontinue. However, if we take this and we look at this, and we compare differential revenue from differential costs, if we actually just look at bran flakes itself, bran flakes had a revenue of $100,000, which you can rewind me if you don't believe me. Bran flakes has $100,000 of revenue, and let's take out just the variable costs of making bran flakes. If you do that, then bran flakes is actually a big winner. Bran flakes is making $15,000 on itself. Right? The fixed costs are not those that bran flakes can control, so you shouldn't penalize them for that. So, as I said, looking at this, now that you've done a differential income analysis, you would consider to keep bran flakes. Following right on the heels of that one, we can look at make or buy. So we're an automobile manufacturer, and we're trying to decide whether or not to buy instrument panels for $240 or try to make them ourselves. But the thing is making it ourselves traditionally costs us $280. But if you'll notice in here, we've got a fixed item in here. Fixed costs should not be considered in the cost of making the product, because regardless if you're making the product or not, you would still have those fixed costs. Okay, so if we just compared the alternatives of purchasing it for $240 or making it ourselves, right? Here's the purchase price of making it for $240 versus making it ourselves, and only considering the variable costs, you can see that the cost savings, it actually would cost less to make the product ourselves. So we would have cost savings of $28 for every instrument panel that we had. Okay,